Just months after receiving tens of billions of dollars in bailout money, the nation's biggest banks are on track to pay their top employees more than ever before. Lawmakers in Washington say that's not right, and they're moving forward with legislation to restrict executive compensation. The House Financial Services Committee is pushing a bill that would give shareholders a non-binding vote on how much executives are paid. It would also impose tougher rules to ensure the independence of compensation committees on a company's board of directors. Massachusetts Congressman Barney chairs the Financial Services Committee. He joins me now from Capitol Hill. Chairman Frank, welcome to Bloomberg News.
Thank you.
Mr. Chairman, that so-called say-on-pay legislation, it is a non-binding vote. Does that mean the bill doesn't have any teeth?
No, we've borrowed that from the British, and it is very rare that a board of directors would defy a vote like that. The reason it's non-binding is a practical one. If you had a binding referendum and the vote was no, you couldn't pay for people. We certainly don't expect people to go without pay. You know, there's a certain clunkiness of having it be the board. So what's happened, and this is a model we've taken from England, which is why, by the way, people worry about a competitive disadvantage for American companies in hiring. The British have been doing this for some time. What happens is if the vote is no, as it has been a few times recently, the board goes back and redoes it. The likelihood of a board ignoring a shareholder vote is very small, right, especially in conjunction with the SEC now putting in new rules that are going to make it easier to challenge members of the board. So we think it's a reasonable compromise. As I said, if you made it binding, you would have a situation which you could not legally pay people, and that's not going to be helpful.
Mr. Chairman, what about these reports we've been hearing about the profits at J.P. Morgan Chase, at Goldman? Public's been expressing some outrage, and so have some members of Congress. Where do you on that, given the economic climate? Do you think that some of this compensation is still way too high?
I think they are being unwise. It is not in the interest of the financial community to have an American public that's very angry. As to the amounts, I divide this. For instance, I read one analyst saying that with one of the major financial institutions, 72% of the profit was going to go to compensation. That, I think, if I were a shareholder, I wouldn't like. And that's why we are empowering the shareholders. So when it comes to the amount, that's up to the shareholder. We do go beyond that with regard to financial institutions and say this. The problem with the pay is not simply amounts, and that's up to the shareholder. If the shareholders are willing to have all their money go to a handful of executives, it's their money. They have the right to say that, but they should have that right. Beyond that, though, we're worried in terms of the impact on the general public of the incentive structure. There's a broad consensus from Paul Volcker, from Warren Buffett, from Ben Bernanke, from the financial authorities in England, in the common market and elsewhere, that the problem here is not simply amount, but the way it's structured. You have a situation where if you are the top decision maker and you take a gamble and it pays off, you make a lot of money. But if you take a gamble and it blows up in your face and if it damages the company, you don't lose anything.
Right.
In other words, it's heads I win, tails I break even. If I told you that you should go out and take risks, and if the risk paid off, you'd be benefited, but if the risk failed, you would break even, you take more risk than was rational.
Right.
So what we're going to do is, I hope, incentivize tell the SEC to have rules that say you cannot have an incentive structure that gives people the incentive to take too much risk. One of the problems we've had is the time horizon. People have said, oh, okay, that paid off over 6 months and I get my bonus. A year and a half later, it may have turned sour, and there's no compensation repay.
Mr. Chairman, the FDIC Chair, Sheila Bair, asked Congress today to impose fees on the nation's largest financial firms to keep the government from having the prop-up companies deemed too large to fail. Would you and your colleagues consider crafting such legislation?
Oh, absolutely. That's already on our agenda. Look, one of the problems we have right now is that when a bank fails, as Chairwoman Bair points out, when a bank fails, it's not fun, but it doesn't cause great disruption. Wachovia failed. Countrywide failed. We are able to deal with that. But when a non-bank fails, we don't have a system in place for dealing with it. So we have a series of bad choices. We had the choice of Lehman Brothers, which was to pay off none of the creditors, and that caused a terrible seizure in the economy.
Right.
So then in overreaction to that, when AIG got in trouble, they paid off everybody. And then you had Merrill Lynch, where there was pressure on the Bank of America to keep it going. So I agree very much. We will, I hope, in September, adopt rules that will give every financial regulator the ability to do what a bank regulator can now do. Frankly, put one of these out of their misery in a little bit quieter way. And yes, it should not come out of general taxpayer funding. Those institutions that have been the riskiest and have engaged in the riskiest behavior should be assessed so that you do have to have some money to wind these things down,
right.
and that's where it would come from.
Chairman Frank, House Agriculture Committee Chairman Colin Peterson told reporters this week that a bill he's crafting with you will include a ban on so-called naked credit default swaps. That ban was at your insistence. Why is that important? Is there a danger that, as some analysts are contending, that that bill could wipe out the entire credit derivative swap market?
Well, it will restrict the credit derivative swap market, and that's been a cause of some trouble. It's lack of regulation. The question of banning naked credit default swaps is on the table. That's really where we got into trouble, which is the lack of regulation of credit default swaps in general. There is a concern on the part of some that it leads to excessive speculation. There are alternatives to banning the naked credit default swaps. I would say this. If we are able to get rules which Chairman Peterson and I have agreed with, and the jurisdiction here is split between the Agriculture and Financial Services Committee because of the historical nature of hedging coming from the commodities business. If we can get rules where almost every derivative is traded on an exchange, and those that aren't, because they are just too unique, have extra capital requirements, then that may do it. So there's no, the credit default swap, the naked credit default swap is sort of a possibility.
Right.
The central part is to find some way to contain these. And when people say, and by the way, this troubles me with the financial community, clearly unrestricted derivatives, both because there was way too much leverage, so that people got in over their heads. That was the AIG issue. There has to be some constraint. Yes, these hedging instruments perform a useful function.
Right.
Here's a distinction I would make. It's very important to maintain in the economy financial entities that play an important role towards the end of productive activity.
Right.
The financial system, after all, is supposed to be the intermediary. It is supposed to be the means to the end of various productive activity. I believe that over the past decade and more, things evolved to where there were some of these things that were just an end in themselves.
Right.
They weren't in the advancement of ultimate productive activity. They were just to make money. To some extent, we're going to try to draw the line between those that are purely to make money for the entity and engage in it. By the way, I don't criticize making money.
Right.
We won't have any important function performed if there's no profit, but that shouldn't be the end in itself.
Mr. Chairman, we're going to run up against a break, but if I might ask, can you stay through the commercial break, or do you have to run?
I can stay a few more minutes.
Thank you. I appreciate that, because we have a couple more questions and we wanted to get those in. Our audience obviously interested in what the chairman of the House Financial Services Committee, Barney Frank, has to say. He's been gracious enough to stay with us through the break. We'll be back with Chairman Frank in just 2 minutes. You're watching Bloomberg News. Welcome back. We're joined once again by Massachusetts Congressman Barney Frank, the chairman of the House Financial Services Committee. He's graciously agreed to stay through the commercial break. Mr. Chairman, thanks. We were talking about derivatives. When are you going to release your derivatives proposal to the public?
Sometime next week. It won't be voted on until September because we're going to take the break. But we have been working hard, and I'm very proud of the fact that Chairman Peterson of the Agriculture Committee and I have worked together, and that the two chairs of the commissions, the Commodity Futures Trading Commission and the Securities Exchange Commission, Gary Gensler and Mary Shapiro, have worked together. If you were starting from scratch in a logical world, you wouldn't have two of those. But you have them, and the political interests are such. Chicago versus New York, agriculture versus finance, you can't undo it. So it's important that we work together, that you don't have arbitrage between them. And I'm very proud of that. And, yeah, the main thrust is going to be much more regulation of derivatives, but not regulation in which market forces are displaced. We're trying to increase the role of the market. That is, what we think is the best is for these to be more on exchanges and in clearinghouses so that market forces can play much better than they are. There will also be, in addition to that, not just for derivatives, but for all financial instruments, a significant decrease in the amount of leverage allowed. Clearly, people get carried away with leverage of 30 and 40 to 1. Right. That's how people get overcommitted. There will be a substantial restriction on leverage throughout the financial system.
Congressman, during that testimony by Chairman Bernanke this week, he told you that if Congress wants more regulation of consumer financial product safety, he'd support it. He added that the Fed's dual mission, keeping inflation and unemployment low, that's what they're there for. Is that something you'd support?
I certainly support the dual mission, and by the way, that's a very real difference between the U.S. Federal Reserve, for instance, and the European Central Bank. They have the unitary mission of only dealing with inflation. We have had since the Humphrey Hawkins bill that dual mission, and I give Bernanke credit for dealing with it. But neither one of those involves consumer protection. In fact, the Federal Reserve's had a disastrous record in consumer protection. Mr. Bernanke was better. But look, in 1994, Congress gave the Federal Reserve the power to regulate mortgages that were issued for subprime outside of the banking system, which is where the problem was. Alan Greenspan flatly refused to use the authority, as he's acknowledged, for ideological reasons. If Alan Greenspan had used that authority during the 90s and into the early part of this century, we wouldn't have had a crisis anything like this. Bernanke did move. He's right. He moved on credit cards. He moved on promulgating a code of unfair and deceptive practices for banks. And he moved on subprime mortgages. But in each case, only after the Democrats recaptured a majority in Congress, to be honest, and began moving legislatively. So his record is certainly better than Greenspan's.
Right.
But that's really not a very high bar. I don't mean to be critical of Mr. Bernanke in this regard. And here's the deal. And it's not just the Fed. It's the FDIC. It's elsewhere. The Fed's got a lot to do. When you are a bank regulator, your focus is going to be on the macroeconomy and on the safety and soundness of the banks. You're not going to have, we find, a lot of energy left over for somebody who's in a dispute with his or her bank, et cetera.
Right.
So I think it is very clear that the administration is right. Consumer protection has to be in a separate agency.
Mr. Chairman, the Dow's back at 9,000, as we've been reporting on Bloomberg today. Good news for investors, but is it too early to pop the champagne corks? Is the worst of the financial crisis behind us?
Oh, I think the worst of the crisis is clearly behind us. But I'm not telling people to pop corks or not. I think I will say this. In March, as we know, the market was dropping earlier this year. And I remember this very clearly. On March 9th, Speaker Pelosi convened, as she often does, and she's been very good in this and very proactive, a group of economists and market experts, private sector people. And we went from there, from that private meeting, on a press conference, and talked about, frankly, some things like short selling and mark-to-market, about hoping that the SEC could intervene to improve those. We talked about other plans we had. And that day, the market went up by well over 200 points. Yes. And it really marked the beginning of this surge. And I take some pride in the fact that I think what we've shown is that we can be responsible, that we can promulgate regulations on derivatives, on shrinking leverage, on protecting consumers, on doing other things that are important, banning abusive subprime mortgages, that we can do those, having a resolving authority so you can put people to sleep without having to choose between an AIG model or a Lehman Brothers model. I take some pride in the fact that there is some confidence in the market that we know not necessarily how to get out of this bind so easily. We're still working at that, although I think we've made progress, but that we know how to make it much less likely that it recurs. So I think that's part of the confidence that's built in. But let me be very clear. I am not telling people to either buy or sell stocks. That is an inappropriate thing for a member of Congress to do.
Yes, sir. Mr. Chairman, might I ask you a question about health care reform? Speaker Pelosi says she has the votes in the House. True?
Well, anybody who tries to second-guess our very able speaker when it comes to the vote, that's one bet I would tell people not to make. But I have to be honest with you. I'm chairman of the Financial Services Committee. I have a very long list of very complicated issues I have to deal with. So these days, I know more and more about less and less. And my opinion on anything outside the jurisdiction of my committee isn't worth very much.
The chairman of the House Financial Services Committee, Barney Frank, Democrat from Massachusetts, who was gracious enough to stay with us through the commercial break. Mr. Chairman, thanks a lot. I appreciate it.
You're welcome.